Guys, I've probably had like 5 or 6 different people reach out to me in the past year and say that because they're a first-time home buyer, that the bank only requires them to put down 5%. And I just want to let everyone know that that's not, it doesn't relate. There could be certain like prepayment privileges and certain benefits you get because you're a first-time buyer, but when it comes to the minimum down payment, what will affect that is 3 different things: your income, your debt, and your credit score. So the bank, the way they look at it is they'll allow you to do a 5% down payment and mortgage you at 95%, right? Because when you buy a house, think of it as like the bank and yourself buying the house together. The bank is giving you the 95% to like give to the seller to close the deal, and so you can own the house, and then you pay them back through what's called a mortgage. And then the other 5% is the minimum that they say you have to contribute in the deal, so that way you can make it all work. And that 5% is based on your income, your debt, and your credit score, not if you're a first-time buyer or not. So hope that kind of helps kind of clear the air there, because some people say, well, I'm a first-time buyer, so the bank only needs me to do 5% down. It doesn't really make sense. What you should be saying is the bank requires me to do 5% down, so they obviously trust that my credit score, my income, and my debt is in place, and it's good enough to their standards, so they don't see me as a high risk, and they'll give me 95% loan, not 95% mortgage. So the more the bank trusts you, the more they'll give you, the more mortgage they'll give you. The less the bank trusts you, the less they'll give you in terms of a mortgage. Therefore, the more down payment you have to give, the more you have to contribute to the deal. You bought a $300,000 house. 5% of that would be $15,000. So if it's $15,000, that means the bank's going to contribute $275,000 and you contribute $15,000. They obviously trust you. If they say, no, you have to do a 50% down payment, that means that they're going to contribute $150,000 and you're going to contribute $150,000. They obviously wouldn't trust you as much then. There's less risk for the bank because they're giving you less money. So the minimum the banks will normally do is 5%. If you can get approved at 5% down payment, then that means your credit, your debt, and your income is good. If they don't like your credit, if it's not, say your credit score is in the 500s or something, it's not high enough, then as an example, then they might want you to do 15 or 20% down to get approved and to be able to at least go and buy a house and get mortgaged. So I hope that helps. Any questions, just let me know.